Hi, Infinite Audit friends. Welcome to the 15th edition of Infinite Audit Talk. Nowadays, financial statement auditing or financial auditing is a must thing for every business operating in Indonesia. A thorough examination of these financial statements must present the actual financial condition of the company and management performance at the reporting date and period. And today, 15th edition of Infinite Audit Talk will discuss about a financial audit 101, evaluation of the financial statement of an organization, company, or institution that are accurate, complete, relevant, fair, and in accordance with accounting principles and, of course, applicable rules. And so I have an opening question for my but what is basically a financial audit?
Okay, thank you, Bunga. Hello, Infinite friends. Welcome back to Infinite Audit Talk. We are happy to meet you again. And since I work as an IT auditor and Bunga as a risk management auditor, this session is basically a journey recalling back our college days where we learned about financial audit. One of the so-called scariest audit out there. While we are not performing financial audit engagement in our daily life, still we want to discuss it since it is such a big part of the audit world. Okay, so your question is about the definition of financial audit. So a financial audit or financial statement audit, or even when we mention the word audit, mostly we assume that it is an audit to an entity's financial reports, is arguably the most popular audit in the world. The term means an independent and objective examination and evaluation of the financial statements of an entity to provide a reasonable assurance that the financial records are at a fair and accurate representation of the transaction that they claim to represent and meet the generally accepted accounting principles, as you mentioned before, depends on which accounting standard or reporting standard we use as the criteria. It provides an independent opinion on the financial statement of an entity, including income statement, balance sheet, and cash flow statement, etc. And it is usually conducted annually or whenever it is needed. For example, when a business needs to make a decision. I think that's all from me. And I have a question for you, Bunga. What are the stages, steps, or procedures in an audit, especially financial audit? Please.
Thank you, Mbak. Basically, the minimum stages in a financial audit, of course, first thing first is the acceptance of the audit engagement. Basically, an engagement in auditing is like an agreement by both parties. In the case of an audit, these two parties are auditor and the company, which is usually represented by management, or maybe for the internal audit case is the client of the internal organization. Before carrying out the audit, there must be an agreement that must be made and agreed upon. Management or the client submits the audit of the financial statement to the auditor, and the auditor undertakes to audit the financial statement in accordance with his competence. The form of this engagement is in the form of an audit engagement letter. The first stage in auditing of the financial statement is deciding whether to reject or accept the audit work. However, to make this decision, the auditor also consider matters such as the company integrity or management integrity, and then identifying risk, assessing the independence, determining the professional competence and also abilities. So in deciding to accept the audit cycle or not, it requires a lot of consideration, not just getting a client. It's basically not only about, money-based decision. This is accordance with the audit objective, namely evaluating. So it's necessary to consider some various factors. And then the second one is the audit process planning. Planning the audit process is the next step that the auditor must know to make an audit plan, the auditor must carry out several activities such as understand the client's business and industry, perform analytical procedure, determine materiality, determine audit risk and inherent risk also, understand the internal audit structure and determine control risk, develop audit plan and also the audit program. And after that, we also have to implement, of course, the audit tasks. After planning the financial statement audit, in this stage, the auditor will perform analytical steps, like test of control and also substantive tasks. In short, basically, analytical testing is carried out by the auditor by studying the client business process, client's business data, and also client business information, and comparing the data with other data information that become the best practice or maybe the standard. Well, the substantive testing is an audit cycle to find errors that directly affect the financial statement. With this, the audit objective to evaluate the have been achieved. And last but not least is about, of course, the reporting itself. The last stage of the cycle of financial audit or financial statement auditing. This report is a form of communication between the auditor and other parties, so it should not be made arbitrary. The audit report must include the type of opinion, the service provided, the object being audited, the scope of the audit, of course the audit objective also, and there are, I do believe, something that need to be declared by the auditor in terms of financial auditing. 4 types of the financial statement audit opinions are unqualified opinion, meaning that the financial statement are presented in accordance with applicable accounting standard. And the second one is the qualified opinion, or in Indonesia is like wajar dengan pengecualian or fair with exceptions. Qualified opinions meaning that the financial statement are reliable, but there are still some issues or items that are excluded so that they are not wrong in making decision. And the third one is adverse, meaning that the financial statement are not presented in accordance with the accounting standards, or there is a material error in financial statement. And last is the disclaimer decision, meaning that the financial statement have material errors and management limits the scope of the examination so that the auditor does not find sufficient evidence. So yeah, that's what I have in mind regarding these questions. And but what basically qualitative characteristic of a good financial report, which is expected when we perform a financial report audit.
Thank you, Bunga, for your question regarding the qualitative characteristic of a good financial report. To answer your questions, first thing first, we need to know what is financial reports or financial statement. Some definition that I learned back then in college basically say that financial statements are formal records of the financial activities and position of an entity. They are usually consist of a balance sheet, an income statement, a statement of changes in equity, right? And a cash flow statement. The objective of financial statements is to provide information about the financial activities, position, and performance of an entity in a certain time or period. It is needed to make an informed economic decisions by the stakeholder. This is why they should be understandable by the readers who have reasonable knowledge in business and economic activities, I believe. Regarding your questions, the elements of high quality financial reporting defined in the conceptual framework for financial reporting of the FASB. Yeah, FASB include relevance, reliability, comparability, understandability, timeliness, and also faithful representation. So for the definition, I took the definition of each element from a paper entitled Financial Reporting Quality, a literature review by Dr. Siria Makanti Herat and Norah Albarki. So bear with me, I will mention it by one. The first one is relevance. Relevance illustrates the capability of making decision by the users. When information in financial report influence user in their economic decisions, it is said that this information has the quality of relevance. And then the second one is reliability in financial reporting. Information must have the quality of reliability in order to be useful. This quality achieved when information which a user depend upon, is free from bias and material mistake. And then the third one is comparability. Comparability is the concept of allowing users to compare financial statement to determine the financial position, cash flow, or performance of an entity. The comparison allows users to compare across time or among other companies in the same period. The next is understandability. Understandability is one of the essential qualities of information in financial reports. Achieving this quality is through effective communications. So the better the understanding of the information from user, the higher the quality that will be achieved. And then timeliness is, it's really important, right? So timeliness illustrates that information must be available to decision makers before losing its powerful and good influences. So I think timeliness means we have to provide it in the right time for the stakeholders. And then the last one is about faithful representation. It's basically the concept of reflecting and representing the real economic position of the financial information that has been reported. So I think that's the elements of good financial reports. And then I want to ask you a question about the objective. What are the objective of financial audit, by your opinion?
Well, the objective of the financial report auditing basically, first thing first is how to maintaining the compliance, of course. When auditors examine financial data, of course, they will ensure that the business organization has complied with all of the regulation that's stipulated by applicable law. If the organization is found to have violated or disobeyed, the auditor, of course, can report it. And the second one is the encourage more accurate financial report. When financial statements are audited, auditor will identify all gaps before presenting the result to the stakeholders. Thus, the reliability and of course the trustworthy of the report becomes much more accurate, much more reliable. The third one is verifying the accuracy of the company profit. Financial audit helps companies to determine profitability more precisely because all figures are calculated as carefully and thoroughly as possible. Therefore, conducting an audit can help you make the right decision to improve the smoothness of business management, how to make it much more seamless. And the fourth one is simplify the loan process. This is basically for the public sector, not for public sector company, but for the private one that utilize loans for their operations. If the financial statement have been audited, it will be easier for financial institutions such as banks to lend some money. Of course, this is because of the audited financial statement are more reliable to to dare to maintain and understand about the real condition of the organization or company. And fifth is about the fraud detection. If there is fraud that may occur in a business organization, it can be detected immediately with the help of an audit, because an auditor will always report the company's financial data based on the authenticity of the facts that found. And six, it's all about how to increase the business growth. An auditor is an independent party, so that all views and suggestions that are given are not in favor of personal interests. This means that making and help auditors as an ideal party to provide financial advice to improve business system, accounting practices, and also corporate financial governance. And last but not least, seventh, assist the company financial planning and budgeting in future. A financial audit helps to confirm that the accuracy of a business financial statement by analyzing every transaction that made. Thus, the movement of the money in and out, of course, can be detailed clearly. Of course, this makes it easier for stakeholders to make some plans, budgets, and of course, make a better financial decision in the future. So yeah, that's the points that I have. And my next question is about what basically the consequences if you don't do a financial audit.
Wow, thank you, Bunga, for such an interesting questions regarding the consequences of our organization or entity doesn't perform an audit to our financial reports. Bunga has mentioned before about the objectives. I agreed and believe that by having our financial reports audited, we could gain things which were mentioned by Bunga. However, what are the consequences of the other way around? What happened when our financial statements aren't undergo an audit process? So first of all, decision-making process couldn't achieve its best output or even outcome. Economic decisions by the stakeholders should be based on one of the information needed is the financial reports that are accurate and fair. Imagine that our decisions aren't supported by the financial reports or statements that are distorted or containing errors. Imagine how big the impact, how different our decision could be when the information provided are different. So the first main consequence is that we doesn't allow stakeholders to make a better, more informed decision related to our organization. And then the second one is I think we couldn't get the trust from the stakeholders, whether in private sectors or public sectors. We need stakeholders' trust to run our business. Imagine it doesn't win the stakeholders' trust. How could we get the investment, the support, etc.? And then the third one is that we doesn't comply regulatory requirements, which could bring us many disadvantages. Even we could be forced to exit the business due to reputational damage. And then the last one is that we couldn't make improvements to processes and internal controls because financial audit usually also identify flaws in internal controls or financial reporting. So I think when we decide that our financial reports aren't audited or doesn't need to be audited, we will have to bear those consequences that I mentioned before. And okay, I think that's all from me. And then I want to ask Bunga a question about, because we work in the government organization, I want to know about why is government financial statement audit important regarding that? What's your opinion?
Thank you, Mbak. Basically, importance of the government financial statement audit. Yeah, of course, audit of government financial statement basically aims to test the extent of the government's ability to implement the state budget. This is, of course, without ignoring the provisions of the law. Audits of the local government financial reports have an effect of increasing transparency and also accountability of state financial management. One of the value that must exist in the good governance principles is the existence of credible regional financial accountability, which is carried out through reform of the regional financial management, including reforms in the field of government accounting, of course. And the implication of the implementing fiscal decentralization and regional autonomy for the central and regional government, especially in the financial system sector, is the need for the budgeting reform. Thus, an understanding of the regional financial reporting system and how to prepare reports based on an appropriate regional financial accounting system will improve, of course, the quality of the presentation and accuracy of the regional financial reports. So yeah, that's my answer. And dear Infinite Audit friends, basically that's our chit chat session today. And yeah, we do really enjoy and happy to be able to discuss with you together in this session. And should you have any input, please drop your ideas in the column below. And you can also reach us out through our LinkedIn, Gresika Bunga Sylvana, and also Nur Imroatun Sholihat, or you can just throw some direct message also through our Instagram at gresika.bunga or at Nur Imroatun. So, Infinite Audit friends, see ya! Thank you so much.
Thank you so much. Bye.